Everybody, welcome to the Basis Points Podcast. I'm Kevin Flanagan, head of fixed income strategy at Wisdom Tree Asset Management. We're going to talk a little bit about the municipal market this week, where we think there's some good opportunities. And back in March, we partnered with Inside Investment, really some of the leaders in the municipal space, to come up with two new funds. Our Wisdom Tree Core Laddered Muni Fund, the ticker there is WTMU, and the Wisdom Tree High Income Laddered Fund, and the ticker there, WTMY. So I thought, who better to have on the show than Senior Portfolio Manager from Inside Investment, Jeffrey Berger. Jeff, thanks for coming on.
Thanks for having me, Kevin. Good to be talking with you today.
So I thought what we would do is just give everybody kind of the lay of the land, right? For munis, interestingly, throughout the better part of this year so far, it really was one of the rare instances of fixed income that we actually were seeing negative returns during that prospect. But, we feel that actually is a good starting point for investors to come in right now. So just give us a sense, what was behind some of that underperformance and kind of like, where are we going, to use the hockey analogy, skate to where the puck is going?
Well, we would agree with that statement. Unequivocally, municipals have had a challenging year. There is no doubt about that. But again, reframing it really, for the investor who's looking at an entry point valuation for the market, what has presented itself, in our opinion, is a very, very compelling opportunity. But it begs the question, really, why year to date we have seen that underperformance. And really, to address your comment in question, in large part, it has to do with a significant amount of supply of municipal bonds. Now, one of the key reasons year to date we have seen such a deluge of supply has to do with concerns earlier in the year that there may have been some reduction or limitation on issuers' ability to sell as much tax-exempt debt. Now, why was there that concern? Well, there was some conjecture that the One Big Beautiful Bill, now law, would have put some curtailment on issuers' ability to do that. Now, with that uncertainty behind us, because we know the law does not, in fact, reduce the ability of issuers to sell as much debt, that concern is rear view mirror. And so going forward, we think that the opportunity set in municipals is quite compelling. Now, the evidence in terms of the valuation really supports that. There's a couple different metrics that municipal investors tend to look at when they are evaluating relative value in municipals, right? One of those is the shape of our yield curve. And if you compare the shape of our yield curve, meaning how steep it is, between short-dated maturities and longer-dated maturities, it's almost at an unprecedented value compared to, let's say, treasuries. So, for example, 10 to 30-year maturity municipal bonds are picking up approximately 140-ish basis points of additional yield, while treasuries are only 52. Another measure will be the ratio of tax-free municipals compared to treasuries. And right now, they're well in excess of 90%, 93% or so when you're looking at long-dated municipals. In lay terms, what does that mean? It means that a municipal which is tax-free is yielding almost as much as a fully taxable treasury bond. So investors who are tax aware, those who are looking for ways to reduce tax liability or taxable income, municipals, in our opinion, are a very, very interesting, if not compelling, opportunity in fixed income.
You'd mentioned the One Big Beautiful Bill, OBBA, for those of you who want to put a little acronym to it. And I think, there was perhaps maybe a little sigh of relief. I don't think as if it was a student body right mentality that the federal tax exemption would go away. But when we do go through these exercises over the last few years of big fiscal kind of packages, there are concerns that perhaps, right, trying to raise some money that the federal tax exempt status perhaps could be tinkered with, adjusted, or maybe removed. And that was not the case this time around as well, right? We have a clean bill and we're ready to go, correct?
Correct. That's as simple a way of putting it as we can. The muni market really was left unscathed from that perspective.
So let's turn to the funds for last few minutes here for the podcast, and give us a sense. I obviously know the thought process behind the underlying indexes and where we were going with this, but just give us a sense first on the core measure itself. What part of the curves are we talking about? Because we mentioned laddered, and I think what's really important for our listeners out there is to also understand that with Insight, we have a dedicated research team as well. That's so important. I've been in the fixed income business more than 30 years, and having a dedicated muni research team for the municipal space is actually quite advantageous. But I also wanted to just mention, what are we focusing on, right? I mean, there's various parts of municipals to talk about. There's GOs, essential services. So what's like the underlying makeup, say, first for WTMU, the core laddered approach?
Well, the underlying makeup, first and foremost, is designed really to smooth out interest rate risk. And what that means is we have exposure across what we'll call the belly, the core, the most essential part of the municipal yield curve, really from maturities ranging from 1 to 15 years. And what that does is it smooths out investor exposure to interest rate risk or volatility. And as bonds mature and roll off, they get reinvested almost like a waterfall or a conveyor belt, or any analogy you really want to use to show an even distribution of exposure across various maturities. Now, within that, your comment about credit is as key and essential to our investment strategy as I could articulate. We have 10 dedicated municipal analysts who have committed their careers really to just looking at the nitty-gritty, the weeds, getting into the essential aspects of municipal bonds. And our preference is to revenue bonds. In general, there are two types of securities an investor purchases from a security perspective when they are buying a municipal investment. One is known as the general obligation. The second is known as a revenue bond. Now, why is it that we like revenue bonds? There are a number of reasons that is the case. First and foremost, we have found an investment advantage in this sector because the preference for most direct retail investors is for general obligation bonds. So it's a way for us to exploit and utilize our expertise of in-house research to identify in a under-researched aspect of the market revenue bonds where we see opportunities. Now, all of this, whether it is a general obligation bond or a revenue bond, really drives home the following comment that I think is generally underappreciated. Whether it is a general obligation bond or a revenue bond, the core principle of our strategies is really to generate high levels of consistent income, consistent with preservation of capital. We don't want defaults. In fact, the probability of a default in the municipal bond market is a fraction of what it would be in any other market in terms of fixed income. And so when you invest in one of these strategies, the investor really should be looking to obtain high levels of tax-free income with diversified interest rate risk concentrated in revenue bonds.
Yeah, I think when we're looking at the makeup of the type of muni funds that were out there, it's really important to understand, what's under the hood for sure. So, the high income laddered muni fund, WTMY, I think what's important to note there is I said high income. I didn't say high yield. So give us a little bit of a sense of what's going into that makeup.
And I really do appreciate that purposeful choice in terminology, because even in the lower rated or below investment grade element of municipal bonds, the default probability compared to corporates is still extraordinarily low. And so when I think about this, I tend to much prefer the terminology of income versus yield. And so what we've designed here for the second product is a really designed portfolio with its core in a structured ladder type portfolio of investment grade securities, complemented with exposure to higher income type municipals. And these tend to be either non-rated or triple B type rated municipals that still have a extraordinarily low default probability, but are generating higher levels of income. So for the investor who is looking for the key attributes of a core ladder complemented with excess sources of income, this may be appropriate or suitable for their consideration.
Yeah, absolutely. So when we're talking about fixed income solutions, obviously there's so many out there, and what are your risk needs, parameters? Are you looking for tax advantage status, or perhaps just using munis as a core holding? It doesn't always have to be considered just for the tax advantage part of a portfolio. And I think that's an important consideration as well. So, Jeff, I think we're going to leave it there. Thanks so much for coming on. I hope to have you on again in the not too distant future.
Pleasure, and I hope to do the same.